Welcome to IMG Insights, our video series that dives into topics relevant to multifamily real estate investing. I'm Dave Mikkelsen, Director of Investor Relations at IMG, and we're a sponsor of investment real estate. We appreciate the opportunity to educate investors on some of the unique benefits of owning apartments. Of course, one favorable aspect is the tax benefit. Looking at after-tax investment returns is really the appropriate way to assess the total returns of an investment, and a lot of taxable shelter is available with apartments. I'm talking with real estate tax expert Ric Say. In our previous episodes, Ric and I discussed subjects including 1031 exchanges and capital gains. If you missed those, I recommend watching those as well. In today's video, we'll dive into some tax reporting basics for multifamily investors. Now, Ric, this is where we work most closely together with you in the partnership and tenant and common tax reporting that you do for our clients. Ric, let's start with LLCs or LPs.
Okay, so most people who are involved in investments like this with real estate are invested either through an LLC, which reports as a partnership, or as a limited partnership. And those two ways are two different vehicles, and there are some legal and tax issues between the two, but generally it allows the investor to be a passive participant in the ownership of the property, and that for the most part reduces the amount of activity that they have to be involved with in terms of the day-to-day operation, while still participating in the tax benefits and the capital gain benefits that we've spoken about through their investment in this kind of a vehicle.
Good. And that's a great coverage of the tax treatment and the tax reporting. Then the other benefits too, and this is a really popular investment vehicle with IMG. I think probably the greatest number of investors come to us as members of our LLCs, but it's passive. There's no liability. There's no requirements to become a borrower or any other kind of ongoing reporting requirements to the lender or anybody else. So it's really a simple way to become an owner in the project, maintain all the benefits of the income and the tax benefits, but have really a passive role with no liability. Ric, let's talk about the two layers of tax reporting. I think one coming from the partnership itself, and then the K-1s going out to the different limited partners or the members.
Right. So the LLC at the end of each year files a tax return, a partnership tax return. It's Form 1065. That's the federal tax form that's filed. And in that form, in that tax filing, the rental income, the rental expenses, the depreciation, all of the pieces of the reporting for that particular investment is done at the upper level, that first layer, that partnership return. And the partnership does not pay any specific tax on the income. Instead, what happens is the net income of the property, the net income for the partnership, is allocated to each one of the partners on a pro rata basis based on their investment percentage. And those profits and losses are passed out to each one of the partners by way of a form called a K-1. So generally, the K-1 is the report that comes to the individual partner, and that K-1 gives that partner their share of the rent income or loss, the credits, anything else that has to be reported by them on their return, and they then take that information and place that information into their personal return, and that's where the income tax that may be due is recorded, calculated, and paid.
Very good coverage. And I think I guess sometimes it's helpful to see things as an example of what it's not. And the LLC or the partnership isn't a corporation. And I think the big difference there is the corporation is paying tax at the corporate level. The LLC or the partnership doesn't pay tax at the corporate level. It passes everything down to the owners of that entity, and then they pay taxes based on their own schedules and how that K-1 flows to them.
Correct.
Most of our properties are owned through a tenant in common structure. We previously discussed how a lot of our clients take advantage of a 1031 like-kind exchange where they sell a property and exchange into a deal with IMG. Rick, can you talk about how these owners do their tax reporting?
In many of the investments, you may have an investor who is a tenant in common owner of the property, and they are not a partner in a partnership. They are a tenant in common, and they own an undivided interest of the property itself. And in that case, that investor has a undivided interest in a larger piece of property, and so on their personal return, they're going to be reporting the income and expenses of the rental property, and they're going to be reporting their own depreciation, and they're going to be reporting the activities on their return as if they were the owner of the property. They'll simply be reporting their share of the total because they own a tenant in common interest, as opposed to being a partner who would get a K-1 with all of that information solidified into just the net items they have to report. Somebody who has a tenant in common interest would be reporting as if they are the owner of the property, because in fact they're a owner of an undivided interest of that property.
That's a great clarification, right? And whereas we'd have maybe 100 to 200 members receiving K-1s, in any given property we've got up to 10 or 15 tenants in common. And so they are receiving that different kind of accounting report at the year end, and that would flow to their Schedule E, like you're saying, just as if they own that property 100% themselves. It shows up in their tax reporting the same way.
Correct.
That's great, Rick. Thank you again for sharing your expertise on that topic. This concludes our video for today, but more IMG Insight episodes are available on demand at our website, where Rick and I keep the conversation going about tax advantages in multifamily real estate investing.